Today's number, guys, is 2012, because not since that period in time have we seen a difference quite like this. The bonds market is starting to flinch, and big tech is the worry. So are we in an AI bubble pop with the canary in Japanese yields right now at decade highs? Well, one thing's for sure, we've seen Wall Street place a couple of large transactions, and it turns out that it could have a lot of impact in what's about to happen next with not just crypto, but also the markets as a whole. With the weekly 20 moving average about to be hit, we've got mean reversion and correlation happening everywhere. So join us today as we go through stocks, commodities, and cryptos into one video that is not to be missed. There's so much going on. Let's cover it all right now together. See you soon. Well, welcome back everyone to The Daily Show. My name's Thomas Atkinson, and in today's video, we'll be taking a look at the macro, the data, and of course, those dark pool trades that have been coming through from Wall Street. Because guess what, guys? They're happening in an asset class that you might guess, and it looks like they're sweeps, which means they were done with haste. In less than 48 hours, we'll have two bits of information: Nvidia earnings, and of course, we'll also find out about the jobs numbers. And while we do expect the jobs numbers to come in with some shocking potential figures, obviously it'll be the reaction that we're looking for. Remember, price action will be key here. Patience, react, don't predict. But let's kick things off here with the bonds market. Then we'll go through some options stuff. We'll go through crypto and Bitcoin, and of course, look at the key levels. But this is a big storyline. Since 2012, we have not seen the tech sector ever look very shaky. In fact, if you usually look at the bonds market, tech sector bonds have always been considered a triple plus, and no one has ever looked at it. Now, one of the reasons has been they've had great cash flow and great cash on hand. Well, that's starting to change as they're all spending big money on a potential future in data centers and, of course, AI. And it has the market starting to worry about their credit ratings, because you can see here index spread to tech spread has gone negative for the first time. This chart coming from the market ear. I tagged it over on X if you want to check it out. It's a pretty big one. It certainly does bring into question whether the bonds market's about to freak out. Now, speaking of that, this chart here from Duality Research over on X actually shows two things that we track here on the channel all the time. And by the way, if it's your first time to the channel, make sure to subscribe and, of course, smash that alert button, as not only will this year be pivotal, but next year we expect to be incredibly volatile due to midterms and many other reasons. It's going to be one of those blockbuster years for traders and investors, at least in our opinion. So let's have a look here at high yield credit spreads. Both of these have currently been sitting, but if they tend to explode, obviously it can bring mini crashes or even bigger sell-offs. And it's one of those signs that we have to be looking at, because if we hit a weekly 20 moving average, then all of a sudden we see spreads widen up. That usually means we're probably going to go lower. If they start to simmer on back down and no one cares in the bonds world again, then usually things are looking a lot better, and it's time to, of course, usually buy the dip. But there is another story going around at the moment, and that is a decade high for Japanese 30-year treasuries. Now, a lot of people have been sending me this chart, and a lot of you have been seeing it as a canary. We've covered this several times. Remember, just about a year and a bit ago, this was the big storyline that crashed markets, or at least was used as an excuse. And during that time, we had quite a lot of faith in, of course, buying the dip over that period due to the fact that everyone was panicking too much. Now, this is a story, this is a problem, but it's always a timing question. And right now, I still don't think it's probably the time. Remember, to create a proper crash, you're going to need a lot of different reasons. And we've already got subprime style things in the automotive industry, AI spend that's out of control, 95% of businesses that are not going to make any money from it, and of course, crypto treasuries. But on top of all those things, we've also got record levels of leverage and debt. And do remember, Wall Street needs to make those bonuses by the end of the year with good earnings right now. So the volatility that we're currently seeing in the market still may be bought up because of the reflex action of what the street tends to do and what retail traders tend to do. Now, on the flip side of that, we have this chart here from Jury and Timmer that we shared in our last video. And I thought I'd bring it up again, which just basically shows that insiders are selling at a rate of 25-1. Now, insiders always sell generally at a higher rate than they buy. This particular chart usually is actually better for buy the dip style scenarios, but this is an unusually high read. And I think it needs to be kind of stored somewhere in your memory and all of our memories, because we may need to revisit that one over the next coming months. As remember, insiders can be correct, but they're generally 6 to 12 months early, and they've now been doing this for about 3 months. So they are, of course, starting to maybe not see as much value in these markets. Another thing that needs to be brought up is we have Nvidia earnings, which is expected to be an 8.5% plus or minus move over the next 24 hours. And do remember, this current earnings season, this one here from 314 Research, actually shows that companies that are beating estimates, sure, they're going up by a bit, but if they miss, they are getting slaughtered. So do remember, if Nvidia misses, and of course, we don't really expect that to happen based on what it's done in the past, it could be a bloodbath out there. And we expect Nvidia to move, of course, as much as a GDP of some smaller country in just a few minutes. It's going to be like that potentially, and it could be a wild session. Speaking of wild sessions, everyone thought the last 24 hours sucked. And of course, if you're in certain sectors, it may not be so good. But Optima put out a good result here in terms of actually tracking all the underlying. And they found something similar to what we've been talking about. 85% of stocks actually over the last 24 hours were up. However, or at least beating the market in general. However, what was down? Yeah, you guessed it, big tech. And when big tech lags or fails, obviously the markets, that is the index, cannot go up. So what we've been looking at recently, including this chart here from Don's Dividends, has shown, and you follow him over on X as well, he's got some great charts, really shows that there's been a movement here from growth over to defensive. And I think it's a really important factor here, because when you're taking a look at the charts, at the rotation, a lot of retail traders, a lot of newer traders and investors, they don't consider anything outside of tech. And I'm sure all of us have been there in the past. We come in, we buy the names we know, Microsoft, Apple, Amazon, Google, that kind of thing. And then, of course, we sit there, win a bit, then start to learn about the rest. Well, it turns out that defensive stocks, especially over the last couple of weeks, have been beating growth. And remember, this is something we've used time and time and time again over the years to really show that there's probably a rotation going on. And we most notably saw that back in June of this year. Small rotation, 1.5 months. Then we started to see tech break out. So remember, price action is key, and sometimes being defensive because the market turns to defense is the right call. And that's what's been kind of around for the last week and a bit. Now, let's talk about this sell-off, because a lot of people are freaking out. And I don't remember a time, and I posted about this on X, where I've seen so many people freaking out and we're down around 4%. Like, I mean, the freak out levels are at what we'd usually see at negative 20% in most periods. And we've been around the market, at least I have been, since 2006, 7. So, I've seen some worse times, that's for sure. And these levels are kind of reminding me of when we're down at least 15%. So you can clearly tell that fear is in the air and a lot of people are polarized. I think the key note here is structure. And we noticed here, based on the market stats report here from Daily 50 Losing, that when you've had so much strength, 138 days up, Blue Kurtic actually went and tracked both of these for the S&P and for the NASDAQ. And what was found is that the rest of the decline was never over 5% for the S&P, so not too bad. Remember, we're already down 1 from this level. And that generally it was a bounce first, followed by, of course, question marks into the next kind of 100, 200 days. And that's going to take us into 2026, remember. So it could still mark a very interesting period, particularly January, February, where you start to see sometimes those sells. Now, when you take a look at the NASDAQ in a similar run, you can actually see here that while all scenarios, and I think that's important, all scenarios did recover, there was one that went down negative 15%, but in most cases, it was again kind of limited to around that 5% in 3 of the cases. And I think structure is a very important factor here, because 7 months up was what we just saw. It's time for some form of pullback like this. It's time for consolidation. Why? We haven't seen it. It's unhealthy not to see it. And actually, it's scarier if we just keep going up without a pullback. You need a certain level of risk in the air. Now, we're in week 3 here from Subu Trade's chart. So we expect, of course, this week to be a little bit weak. Then next week, maybe still some weakness. And then potentially we start to turn around. Why? Well, that's what kind of the stats show here. And it also makes sense when we look at things like the weekly 20 moving average. Now, some good signs for this market before we go into a couple of bad ones. Earnings sentiment is good, and of course, earnings expectations are extremely high. And this is good because it means that even if we simmer here for a little bit after these major earnings, we'll see what Nvidia brings. Although do remember, guys, Nvidia has most likely sold everything in advance. They've definitely got demand because RAM price is out of this world. And we do know that they're pretty much ruining our gaming Nvidia chips to go and build data centers. So clearly EPS growth is looking pretty positive. However, what that really helps is it helps with the expectation next earnings season to maybe ramp us into that. Are we going to live up to the expectation, specifically of the Russell? Not so sure about that. But this is that chart we alluded to before. Of respondents on the FMS investor survey, we actually found here that everybody thinks that big tech companies are over-investing in data centers and other things. I thought that was a really interesting chart. This is from Bank of America. And you can kind of see here that that's the general expectation. And what could happen here is it could actually start to not eventuate into profit. Remember that latest MIT survey found that 95% of these tech kind of expansions are not going to make any money. And the winner might win, but some of the losers, even in big tech, may lose big time. So this is going to be, I think, the story of 2026, which is, have they spent too much? Are they getting a return? At some point, the market says, give me more money. And we've seen that with several stocks being in growth phase. When they say, we want more money, and they don't get it, they start punishing the stock. And one of the warning signs of this is, of course, this chart here from Callum Thomas from Top Down Charts, which I love. And it shows that private equity is declining while the market is going up. And that just shows you that what we do have here is a sick market that is being driven by 10 stocks that is also seeing a bit of rotation now defensively and has tons of leverage in it. So if we do get an unwind at some point, it could be catastrophic. And I believe the Google CEO or something recently came out and said, if AI fails, all of us are going down big time. Well, of course, the story and the press is like that, but fear and greed is also incredibly weak. Now, doesn't matter what survey result or fear signal you look at right now, even with down 4% on the S&P, where it's sitting at like 20. And here, of course, on crypto, we're sitting at under 10 at the time of this recording. But the good news is for crypto fans is that Bitcoin may have stabilized. First up, let's take a look at this one. 24 hours ago, we talked about how the whales had likely bought in around 89 to 93,000. Now, that's just activation of whale accounts, but we now have more information from the ETFs. Take a look here from volume leaders, dark pool alert, guys, sweeps too. So that basically means they're very fast transactions, secret transactions, if you would. And we have often seen fairly fast reactions off these to at least being partial by the dips. And if you've been watching the channel for a while, you would know that we bought up these ones as well. And they can give you at least temporary reprieve. Of course, we're not through the problems yet. Going to have to get through that, but it does look quite positive. We've also seen another kind of narrative story breakdown as well. Now, a lot of people look at global M2 liquidity as the best thing ever, and this became a very popular story. I would say probably last year in 2024 near the end, everyone started awakening to this. And of course, we used it for a while as well, but it does seem to have disconnected. Now, this is not the only way to look at liquidity. So actually, Bitcoin's kind of been following liquidity pretty well, but we do need to remember that this is a multifaceted approach. The problem is that we've got a lot of decline coming from actually government policy, from, of course, the Fed and the way that they're doing cuts right now and the speculation over those. And there's so many different things. Whenever you're looking at one read, don't just use one. We like to use many. And of course, I do have 7 keys that I built into my advanced course, if you're ever interested in finding out that, to give you lead indication. And no, this is not one of them, but certainly I do look at liquidity just in a different way. Now, some other good signs here for crypto that aren't that one, which is, of course, permanent holder addresses have started to activate a little bit more here. And you will notice that, of course, a lot of the time when you get these massive spikes in it, you're actually at the tops, which is, I think, very interesting. But sometimes you can also be at the dips. So it tends to happen either at extreme tops or at extreme dips. This time it's happening at a dip that also just happens to be a massive trend line, which we'll look at soon. Also, remember, daily sentiment is in the dirt here from Seth Golden and TradeFutures.com, and clearly it is low. And when you get this plus a good technical, then you've got to like what you're seeing on the charts. We also know that liquidity, or that is liquidity sweeps, did happen, and liquidations certainly occurred because this was the level that we saw a lot of stop losses at. And the next level to really watch after this one is going to be down here at about 84K. And 84K, I really think should hold if we do get down there. Although I suspect that even if we get a breakdown again, it's probably going to be bought up based on some of the evidence we're seeing at this stage. Plunging confidence in overall surveys, is that good for one of our favorite asset classes, gold? Yes, it is. And of course, we've talked about that. But really, the next 24 hours is going to be dominated by that FOMC thing and Nvidia. 8.5% on the options, guys. We'll go through the chart in just a moment. So let's now have a look at the S&P, then go options, then go lead indicators. First up, we have the S&P right down here. It's hitting close to that 6,500. And that's going to be an important level because, take a look here, the old weekly 20 moving average. And you might say, why do you make such a big deal out of this? It's a big deal, guys. This one is mean reversion. I love the weekly 20 moving average. I've loved it ever since I found out about it back in 2008, 7, whenever it was. Most people, the first indicator you ever find is moving averages. And you know what? It's not bad. So the 20 moving average is a huge deal on the weekly. We're getting down there. And of course, we're also seeing a couple of other things happen there. Not only do we have potential support here at 6,500, but we also have a really good weekly 20 moving average, put support, and some anchored VWAPs as well. So there's quite a lot going on if we do go even a little bit lower. Now that we did take this lower low, though, it does open up further selling. So I think it's clear that there's a real potential here that we sell a little bit more off. And do remember that this at 6% is a perfectly normal pullback. But this is a close underneath that wick, which does signify at least rallies may be met by at least some selling, at least initially here in the markets. So let's take a look at the puts because they are stacking. And you guessed it, 2 levels, guys. Right where we close, 66.20 and 6,500. Yes. Look at this 6,500. Look at it. Yes, very good. So the 200 pointers are the most important clearly right now, and puts are everywhere. So what this really is meaning, especially when you look at this date, because of course this is a big options expiration, quite a lot of volume on it, that we could go down to 6,500, but it's probably going to get stacked massively should we get down there. So that is going to be a huge level to look at. Tesla 400 remains, of course, the big put support. Then underneath that's going to be that 380 level, which you can see here. Nvidia still not much going on. Weird, not too much flow actually. I mean, there's heaps of options, but not anything particular. More people betting on the bull side than the bear side, but I wouldn't say you have too much edge there in the options world for that this time around. And interestingly, IBIT, which is of course Bitcoin, has come back above that put, which we know is huge. So this 53 put is big. And it's on that massive options expiration. So with dark pool trades, with all the things going on right now, with the big trend line hit, you can kind of make that case that things are improving around that level. Now, what about gold? Well, gold has been wild. And it's gone up, it's gone down, it's gone everywhere. But it's doing exactly what we'd expect, which is having a breather after what has been an epic run. Remember, we've been bullish on gold for 2 to 3 years now, and I love gold, and I still love gold, and I still think it's going to make new all-time highs in the future, but it's just having a breather right now, guys, and we'll update when the chart looks a little bit better in terms of activation. Now let's have a look at the options world and the bonds world. So first up, bonds here. Do we spike above? If we do, we could be going into a little bit of a flash sell. So, of course, we need to be watching that one very closely. And I alluded to this one at the start of the video, which is obviously corp bonds. And what we're seeing on corp bonds right now is a decline. So, effectively, we're back at a big key level of support. And if corp bonds start to weaken more, that is actually a freak out in the bonds market. Now, remember, we haven't had one of these. Since rallying off April, we've had no real weaknesses. We've had no real signs of anything. Last time when we came down here in September, we bounced off the very same level. It doesn't look as good anymore, does it? But still, we made a high after that. And the general gist here is that do we see the bonds market actually start to flinch more? It's started to already show weakness, but it hasn't, I think, freaked out yet. And I think every time, we sell off, you're always going to have a reason why that's happening. The good news right now is that strength tends to bring more strength with it, at least initially. And as we saw with those 50-day moving average losses, in pretty much all the cases that we have seen in the past in similar circumstances of great runs, there's usually been a buyer at least within that first kind of 5% after losing the level. And that makes some sense when we're looking at the markets. Dollar index is at resistance, guys, but not broken through yet, coming off that daily 20. And gold is floating around at exactly the level we kind of talked about. There's a possibility we go down to 39.50 as well. And I'm watching 41.10 as a breakout to show significant signs of at least temporary bullishness. And you can see here I've got an alert for silver above 51.40. Silver seems stronger. Silver's actually been rallying a little bit better. So again, bouncing after that big rally, and we do expect it to ultimately be going up at this stage. Oil, no updates on that. No breakout of 63, so no real changes there on oil. And Tesla continues to look weak. Once we gave up this 420, 410 zone, we obviously knew that it was probably more weak than strong. Why? It looks like a double top at that point. So, of course, it opens up the possibility of 350. Look, the jury's out on this one. We've seen the options. We know 380 and 400 are key option puts. So if we drop 380, you guessed it, guys, we're going to go down to 350, I think. So for now, I think that the bears are in control of that stock until Elon comes up with a new way of spinning it, I guess. Now let's move over to Meta. What's happening there? We got a gap fill. We saw a large dark pool, so we obviously saw a large trade through here, and we failed to make a higher high. So we've failed to change trend yet. But is this an interesting one? It's certainly starting to look better on the PE ratio, and maybe what we'll do later on this week is we'll have a quick look because the stock is starting to look a little bit more acceptable even though it's gone down. And a lot of these stocks are starting to look a little bit better as well. So obviously some are quite weak, like Amazon at the moment, filling gaps and going down. Oracle's another name that people are looking at. But opportunity could be coming in all of these markets. All right, let's take a look now at the big one, which is Nvidia, 8.5% expectation of move. So we're now at the key level of support. If we lose 8.5%, let's just say that did happen, we'd go down to about 165 at 8. So this would be exactly where you'd expect the support to come in, right in here. And of course, if we went up 8.5, you're basically not even double bottoming at that point yet. But is this key level? Yes, it is. And often this is what happens into a news event. A monstrous level is tested. And that's why when you go back through and you look at TA in history, you'll say, oh, look how obvious it was buying off that dip. Problem is there's an earning sitting on it. Now, if you're going to go with averages, you're going to say it's a beat. Why? Well, there's only one miss in years. So, of course, you're going to think it's a beat. RAM price may dictate that as well. But it's more the reaction to the market. And, of course, if we're going off evidence, if they beat and they beat okay, then generally the market's been rewarding the stock. And if they miss, yeah, it could be a huge sell. So we might be going down to 165 relatively quickly. When it comes to semiconductors across the board, you guys know that I'm tracking this very closely and we all are together. And we're back down at those supports. And of course, losing semis here makes perfect sense. We're not quite at that major support, which is about 325. So we may have a little bit more to fall. Again, look at that correlation. Weekly 20 moving average. Bitcoin's probably potentially bottomed here at some point. So this is all looking like correlations coming across. And that's one of the things we love here to do on the channel. Bring TA with data, with, of course, a macro view as well, and try to cut through, for lack of a better term, the crap. Now, let's have a look here at the Chinese markets. You guys can see here a pretty decent level of correlation support as well. Chinese markets selling off the last couple of days on liquidity concerns. I'm not too concerned about that. I think the Chinese market will get liquidity back in it and it still remains bullish on the higher timeframes. And of course, then there is the NASDAQ, the weekly 20 moving average, really overdue, big support level. We lost 600 on the Qs. So obviously you're going to be technically looking at that as the next big zone here. And you can see it's currently trading around 596. So I like anything in here based on the current structure that we've seen. Really big buys, obviously mostly bullishness, and there's always going to be a concern. But the concern here is about growth and spend and AI bubbles. Well, have we had a bad earnings? Not really. Now, Nvidia might prove us wrong there, but generally speaking, that's the evidence we go in with so far. What about crypto? Well, Ethereum has hit the mini bull level, has not rallied above 3250 yet, so we'll be watching that one. But you can see here, Bitcoin on the log chart has a really nice trend line hit, has a really nice anchored VWAP hit, has obviously some fib pullback as well on the last rally. And you've got to remember, we did liquidate a bunch around this level of 93, 94, which is what we kind of suspected. Now, if we give up this level, I would say we're going to 84 because 84 is the next zone. So if we give this up, that actually gets kind of scary. But if we do hit this, we want a quick bounce. And all we know is that someone believes in it because there was a large dark pool sweep and there has been a lot of activity suddenly come in at right around this price. Another thing that we're watching right now is the DAX because, of course, the DAX has started to look weak. And if the DAX gives up this support here, basically a Wyckoff. And that could be a really bad warning sign of a deeper pullback. So a lot of correlations, a lot of bonds markets flinching, a lot of things going on right now. Do remember FOMC report 2 p.m. on Wednesday after hours. We've got the 8.5% move expectation from Nvidia. Could be nothing, could be a huge amount of move. But remember, guys, things are going to be volatile. Make sure to follow us over on X for the latest details. Follow me on LinkedIn as well. I posted what I think was a really good write-up about Michael Burry and my thoughts there. By the way, Burry's been busy, I believe, over the last 24 hours. Maybe we'll do that in the next video. So much to cover. And of course, sign up for our newsletter and check out our courses if you're interested. Guys, I hope you have a fantastic day. Remember, when everyone else is panicking, sometimes it does pay to have that kind of iron stomach when it comes to markets. But the key is to put together the details. Patience, react, don't predict. In this case, we're starting to see some signs here of life, especially in the Bitcoin market, and everybody is freaking out under the desk. So, it's always important to bring together the evidence. Remember, do your own risk research. This is not a signal to buy or anything like that. It's just the evidence that we're building together. Have a great day. We'll catch you for now.